All right, let's get right into it. For the past few years, real estate syndication has been pitched as this golden ticket to passive wealth. But, a storm is brewing. And for a lot of investors, a really painful reality check is about to hit their mailbox. Today, we're going to break down the capital call nightmare that's coming and how it could turn these dream investments into total financial disasters.
Look, this isn't just some clickbait headline. This is a real warning. If you've seen those slick social media ads promising mailbox money and massive returns, you absolutely need to understand what happens when the easy money just vanishes. The very thing that promised you passive income could soon demand that you pay up or lose every single dime.
So, here's how we're going to tackle this. First, we'll look at why these deals seemed so perfect in the first place. Then, we'll uncover this massive ticking time bomb in the commercial debt market. After that, we'll break down the exact math that flips a great deal into a terrible one, explain the nightmare scenario of a capital call, and finally, I'll give you the tools you need to spot the warning signs yourself.
To really get the problem here, we first have to understand the promise. So let's rewind the clock to the boom times, back around 2021, and see why billions of dollars from regular investors like you and me poured into these real estate deals. It was a time when it honestly felt like you just couldn't lose.
It was truly a perfect storm. On one hand, you had the Federal Reserve holding interest rates near zero. Money was practically free to borrow. And at the same time, property values were just skyrocketing. So syndicators step into this with this incredibly powerful pitch. Hey, you give us your money, we'll go use the bank's money, other people's money, to buy these huge apartment buildings. You get to be a passive owner, collect checks, and get these high preferred returns without doing any of the work. Come on, it sounded absolutely foolproof.
And the business plan they sold everyone was just beautiful in its simplicity. So step one, buy an apartment building, usually with a short-term floating rate loan called a bridge loan. It's just designed to get you from point A to point B. Step two, renovate the units, slap on some new paint, and raise the rents. This increases the building's net operating income, or NOI, which is just the revenue minus the day-to-day operating costs. This whole process is called forcing appreciation. The higher your NOI, the more the property is worth. And now for step three, the magic key. Refinance that shiny, more valuable property with a brand new long-term low-interest loan. This pays off the original bridge loan, gives you your initial investment back, and everyone just sits back and enjoys the cash flow. The problem is, step three is now basically impossible.
See, that entire model, that entire dream, it all depended on that final easy refinance. But the world changed, and now all those short-term loans are coming due. And this isn't just a problem for a few bad deals. This is a systemic issue that's hitting the entire commercial real estate market.
Let's just talk about the scale of this thing for a second. Between 2025 and 2026, we're looking at an estimated $1.8 trillion in commercial real estate debt that's about to mature. Just let that number sink in. Nearly $2 trillion in loans have to be paid back or refinanced in a very, very short period of time.
This is what the experts are calling the wall of maturity. And every single one of those syndication deals that used a short-term bridge loan back in 2021 or 2022 is now running headfirst into this exact wall. The cheap debt they were counting on is just gone, and it's been replaced by some of the most expensive borrowing costs we've seen in over a decade.
Okay, so you might be asking, why can't they just get a new loan, even if it's a bit more expensive? Well, it's because the fundamental math that values these properties has completely flipped on its head. So let's actually get into the numbers here and see exactly how this works.
Okay, first, you have to understand the single most important metric in commercial real estate, the capitalization rate, or cap rate. It's actually pretty simple. You just take the property's annual income and divide it by its value. Now, the crucial point here, the thing you have to remember, is that cap rates and property values have an inverse relationship. They're like a seesaw. When cap rates go up, property values go down, even if the building is making the exact same amount of money.
And this table right here perfectly illustrates the squeeze. Take a look at the 2021 column. That was the promise, right? Interest rates were low, so cap rates were low, maybe 5%. A building making $500,000 income was valued at a cool $10 million. You could get a $7 million loan at 3.5%, and your monthly payment was about $26,000, leaving tons of positive cash flow. Now, look at 2026. This is the reality. Interest rates are way up, which pushes cap rates up to, let's say, 7%. That same $500,000 in income now means the property is only worth about $7.1 million. The value has been completely crushed, and the payment on that same loan is now almost $49,000 a month. It doesn't just wipe out the cash flow, it creates a massive monthly loss.
And this is the final nail in the coffin. See, banks won't lend you money unless the property's income can cover the new, higher mortgage payment by a safe margin, usually 1.25 times. It's a rule called the debt service coverage ratio. But as we just saw, these properties are bleeding cash every month. They don't even make enough to cover the payment one time, let alone 1.25 times. So refinancing isn't just difficult, it's mathematically impossible.
So now the property is trapped. Its short-term loan is due, its value is cratered, and it can't qualify for a new loan. The syndicator has completely run out of options, and this is the exact moment the problem gets passed directly onto you, the investor. This is the capital call. It's a clause, probably buried deep in that operating agreement you signed, that gives the syndicator the legal right to demand more money from you. They need cash to cover the losses, to pay for repairs, or, most importantly, to pay down the loan just to have a prayer of refinancing. Think of it exactly like a margin call in the stock market. Your investment is deep underwater and you have to put in more cash right now just to try and save it.
And your choices here are just brutal. Option 1, you send them more money. You're throwing good money after bad, just hoping you can keep the project alive long enough for some kind of miracle to happen. Option 2, you refuse to pay. And if you do that, the agreement you sign typically allows the sponsor to massively dilute your ownership stake, or in a lot of cases, just wipe out your initial investment entirely. It is a true no-win situation.
But wait, what about your preferred return? That was the huge selling point, wasn't it? Well, this quote from the classic book The Intelligent Investor tells the harsh truth. Preferred does not mean guaranteed. It's not like a bond where you have a real legal claim. You're still an equity owner, and when things go bad, you're way down on the list of people who get paid.
To see exactly why your investment is so at risk, you've got to understand the bankruptcy waterfall. In any foreclosure, there's a very strict pecking order. First in line is the bank. They get paid first, period. They have a secured claim on the actual building. After they are paid back every penny, maybe the sponsors or any preferred equity holders get something. And who is dead last, getting whatever scraps are left over, if there are any? That's right, you, the common equity investor. And in most of these scenarios, the scraps add up to exactly zero.
So yeah, it's a grim picture, but knowledge is your shield here. Now that we understand how these deals can blow up, let's look at a few key warning signs you should always be screening for in any deal to protect yourself.
Okay, this is a classic mistake, confusing vanity with reality. A sponsor might brag about 98% physical occupancy, which just means that nearly every apartment has a person living in it. But the number that actually matters is economic occupancy. How many of those tenants are actually paying their rent on time? A building can be physically full, but hemorrhaging cash because a fifth of the tenants aren't paying. You have to demand to see the actual rent collection reports.
And here's a quick checklist you can use to stress test any deal that comes across your desk. First, question the narrative. Why is the current owner really selling? Is it because they see this storm coming? Red flag. Second, verify the income. Are the rents truly below market, or is that just some rosy projection? Third, check the expenses. Is their budget realistic? Usually around 40 to 55% of income. Unrealistic expense projections are a massive warning sign. And finally, run your own test. What happens if income drops by just 5% or expenses jump 10%? If the deal immediately goes cash flow negative, it has zero margin for error and it is way too fragile to invest in.
Look, the dream of passive income is incredibly powerful, and for a little while, cheap money made it seem so easy to achieve. But the foundation of any good investment is its ability to survive reality, not just thrive in a dream. As this wall of debt comes due, a lot of investors are about to get a very harsh wake-up call, and they're going to learn that sometimes the most passive investments can end up demanding the most from you when you least expect it.